What's going on, YouTube? In this video, we're going to go over Verizon Communications, ticker symbol VZ. Year to date, this company is down 16.6%, and of course, 1 year down 7.5%. So Verizon just reported their Q3 earnings, and they barely missed on their revenue, but beat on their EPS. So earnings were pretty decent, came in line with expectations with a slight beat on the EPS side of things. So in their earnings summary, one of the more important things in this whole summary that investors were taking a pretty close look at is the free cash flow. They want to make sure that dividend is probably not at jeopardy, because if that dividend comes into jeopardy with the company, I think that's going to drop this share price quite a bit. But it does not appear to be the case, because their free cash flow year to date was at 14.6 billion, an increase from 12.4 billion in 2022. So their free cash flow has grown. So even with a decrease in total operating revenue of 2.6%, they're still able to pull out a higher free cash flow year to date compared to last year, with a net income decrease of 2.8%. So they're still able to pull out higher free cash flows even with a decrease in net income and revenues. Obviously, we don't want to see decreases in revenue or net income, but that is kind of expected right now. But as long as those decreases are relatively minimal, I don't think it'd be too big of a deal, as long as the company can maintain a good positive free cash flow, so that way they can afford to pay out their dividends. Another big thing I believe investors were paying pretty close attention to is how they're paying back their debts, because of how much debt Verizon has, and obviously interest rates are up substantially. Last quarter, they focused on paying back some unsecured debt that they have. They decreased it by $5 billion, now down to $126 billion. And sequentially, the company's net unsecured debt balance improved by $4.3 billion to $122.2 billion at the end of the third quarter. So one of the reasons why it's, in my opinion, it's pretty important for Verizon to start focusing pretty heavily on paying back a lot of their debt the best that they can without causing any financial hardship, is because in the last 3 months, they paid out $1.4 billion in interest. Can you imagine if they were able to add in $1.4 billion back down to their bottom line here into net income, what that would do for their free cash flows and how much stronger their balance sheet would look? So I think one of their biggest focuses, especially with high interest rates right now, is to get this long-term debt right here dialed in and figured out, because that's what's causing a pretty big expense into their net incomes, is their interest expense. So I think that's something else that we got to be, you know, I would like to really see them do that, is to focus quite a bit on getting their debt paid down, because then it would make their balance sheet stronger, and it would give us a little more security behind the company, because there's less debt to worry about. Because when you buy the company, you're essentially, acquiring some of their debt. So on their free cash flows, come down here. Here's their CFO of $29 billion roughly. This is over the course of 9 months. And so we take our 28.8 minus $14.2 billion, which is our capital expenditures, gives us $14.6 billion free cash flow in 9 months, or $19.4 billion annualized. So what they're guiding for us, though, for the rest of the year, is we're looking for $37 billion of CFO, about $19 billion in CapEx. So we're looking at about a $5 billion capital expenditure next quarter, which would be a slight increase in comparison to the average of the last 3 quarters there. And then that gives us a free cash flow guidance of $18.9 billion, so slightly lower than what we would roughly expect for the fiscal year. Last year, this time, their dividend payout was at 65%. Currently this year sitting at 56%, so a good decrease in percentage payouts on the company, even though they have increased their dividend in that amount of time as well. So pretty good there. And then after they do all that, they added $1.5 billion to their balance sheet. Even though they paid down debt, they paid out dividends, they're still able to add $1.5 billion to the balance sheet. So pretty good. Over at the financials for Verizon, we can come over here. We've got all of our charts over here. We've got our revenue, gross profit, net income chart. Just a flat company, just kind of just stagnant right in this same range, just kind of humps and dips a little bit, but pretty consistent. Net income over time has somewhat kind of trended higher. Obviously, as of late, kind of sort of going a little bit lower, but it's still maintaining a pretty decent, net income. Gross margins in at 58.6% historically has been better. Net margins, though, pretty good compared to history. I mean, obviously not the best, but still pretty solid net margins. Revenue, gross profit, year-over-year change. I mean, this thing just bounces back and forth on around 0 for growth rates, and currently slightly lower as of lately. Return on invested capital sitting at only 8.46%. We're gonna have some competitors to see where relative to the industry is. See if 8.46 is not a good return on invested capital for this particular industry. Obviously, historically, they've been a lot better. Would like to see them more up here in the mid to high teens range, but currently sitting at 8.46, and we'll get a good comparison to some other comparables on return on invested capital. PE ratio currently sitting at 6.73 in the last, 9 years. That's the lowest it has ever been based on the yearly average. Cash to short-term debt. This company's just got a lot of debt. So they got 55, almost $56 million in short-term debt and only $4.2 billion in cash. Cash to total liabilities, they got $286 billion in total liabilities. And down here, you can see $4.2 billion in cash. They grow this debt too much more. You're not even be able to see the cash bar down there. Net income to free cash flow, they do produce more net income than free cash flow. That is typically what you want to see, because if not, then they're probably doing a lot of depreciation, amortization, potentially a lot of stock-based compensation as well. Or there's a big change within the company. It's not always a bad thing, but there's usually consistently you want to see this. Maybe not, you don't want to see about half. You want to see it pretty close to what net income is, like this chart right here. You want to see what it did in 2021. You want something closer to that, in my opinion. That's what I look for. Free cash flow, we've got, kind of a roller coaster ride of free cash flow, but I guess on the upper end of where it has been historically. So about sitting at $13.6 billion free cash flow. Share count dilution, over the course of time, this has been diluted over, and it is still getting diluted as shareholders. They're sitting at 4.2 billion shares on this company, which is a lot of shares. Capital expenditures, starting to grow again, but again has retracted a little bit. We'll have to see. I know they mentioned that they're working on reducing their capex going forward, so that should hopefully come back in line, maybe closer to $20 billion in capex, which would then help out free cash flows, which then would make this dividend even more safer than it currently is. Comps, Verizon, T-Mobile, AT&T, and Charter for our company comparisons here. So over here on Verizon, we got a return on invested capital is less than 15%. Operating cash flow is higher than net income. Share change year over year, slight increase in share count. And we have very minimal growth at the company for the next 5 years there. Market cap, compared to the industry here, we're seeing where Verizon is, market cap to revenue. Company almost does, just like AT&T, almost does equal or more revenue than what the market cap is currently sitting at. Charter, same thing. Charter's sitting at about equal for market cap to revenue. But we got T-Mobile that's doing the complete opposite. So we got revenue, gross profit on the board here. We can see where everybody's sitting in terms of revenue to gross profit to net income. And AT&T is our -1 on the board. Everybody else is positive net income. Growth rates, looking like T-Mobile's got a pretty good growth rate coming up, but everybody else, really Verizon has the lowest anticipated growth rate for the next 5 years. Gross margin sitting at 58.6%, pretty much right in line with everybody else. The leader in operating margin and the leader in profit margin. Free cash flow, doing $13.6 billion, and the company that's doing the most amount of revenue is actually going to be Verizon. So Verizon does the most amount of revenue, so we should expect them to possibly have the highest free cash flow, which actually AT&T does right now. But the concern with that one is the fact that their profit margin right now is negative. So they're not making money, but yet they have a high free cash flow. That's something worth looking into, but that's not something you usually want to see, depending on what's going on with the company. I haven't looked into it to see exactly what that is, but when you have negative income, but you have positive free cash flow, there's probably a lot of stock-based compensation, a lot of depreciation, amortization, and maybe something else is going on as well. Return on invested capital, this is what I was talking about before. So we can see 8.46. Somehow AT&T is pulling off 17% return on invested capital and everybody else. I would probably say that Verizon is maybe where it should be in terms of return on invested capital. Price to earnings, Verizon, cheapest one on the board. AT&T obviously looking cheap, but it's because it's negative and negative earnings right now. And Verizon doing just fine on earnings. Over here on the calculator spreadsheet, and if you guys are interested in the calculator spreadsheet, it is now available on Patreon, and I'll drop a link to that in the description below. Peter Lynch fair value on Verizon is sitting at 5.74. Multiples comparison, because AT&T is negative, we will remove AT&T from the list, and then that gives us an $81.89 per share for comparables. Manual PE gives them 11.1 years to earn their current market cap, so not too bad there. Price to book, 5-year average, 2.72, currently at 1.42. Pretty good. PEG ratio, not a growth company. Graham's valuation gives them intrinsic value of $25.64. And keep in mind, this is also telling us that with a growth projection of negative 1.24. So if we were to change this to 0 or something like that, that would actually obviously grow our Graham's valuation a little bit. Dividend discount model, currently at $33.73. Discounted cash flow, analysts have a growth rate of 0%. Historically, they are able to pull off 20.6%. I'm going to match their 0% just because of their current revenues are declining slightly. So I can't imagine their gross profit or their cash flows are going to grow much. And if they do, then that's just a bonus to our valuation. So currently that gives us $44.22 per share. Rule 72, this is kind of designed for a growth company as well. This calculator in its entirety. So we're just going to eliminate this one from our final valuation. So come over here, summary of Verizon, currently trading at $33.44. We have a fair market value of $29.92 per share. 30% margin safety, $20.95. Analyst price target is $42.64. But I want to remove Rule 72 because that's more for growth companies. And once we remove that, that gives us $35.95 per share. So again, another thing you could do if you feel as though it's necessary is removing the Peter Lynch valuation because it gives it a negative valuation, mostly because it is as zero growth, it's negative growth. So I mean, one of the biggest things with the Peter Lynch valuation is measuring the growth of the company. And really, that's not a growth company, so it's probably another one that we could probably eliminate from the list. And that would, the rest of these valuations though, don't solely focus on just growth. Benjamin Graham would be the next one. Discounted cash flow obviously as well, but we had a 0 plugged in for discounted cash flow and it still gives them a good price per share. So then what we could probably safely assume on this company for a fair market value is going to be $46.37, and then your 30% margin safety is $32.46. And we can see we're pretty close to where analysts are based on making those couple of changes there. Now, we don't want to skew ourselves to analysts because we don't know where analysts are getting their numbers from. They could be projecting forward. You just don't really know, but you know where you got your numbers from, and that makes this more, I think, more confidence in your analysis when you do it yourself. Now, on the stock chart for Verizon, as of last week, we finally have potentially broken trend. We did not really 100% close above trend here. We might have just tried to break through it depending on where you draw in this trend line. But there's a chance here we maybe have reversed. There's a chance. We technically closed above trend. We ran up probably into some resistance here, which kind of makes sense. We might pull back next week, retest this trend line, which is usually pretty common. We'll pull back, retest this trend line here, and then potentially maybe even just follow this trend line lower and then hit this trend line down here about $32 per share. And then maybe we consolidate a little bit, and then maybe we make a resumption higher once the market decides to start making some green days again. Right now, obviously, the market is just red day after day after day. So that's what we're looking here on Verizon. I think we're pretty close to the bottom. I think we're looking for a reversal here pretty quick. I think this thing will still pull back a little bit to $32 per share before it maybe resumes higher. I think it's going to take the market a little bit to help this company push back up higher to where, up to that $40 range where we got it valued at. So, but that is it for Verizon. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.